Hi, Money Truth Podcast listeners. I'm Megan Gorman, and I'm going to be your host today. Now, joining us today, we have a repeat guest who I'm really excited to have on. We have Greg McBride, SVP and CFA of Bankrate.com. Greg, thanks for being back on the show.
Great to be with you again, Megan. Thanks for having me.
Yeah, now I know you appear all over from the Wall Street Journal to TV and so on, but tell our listeners a little bit about your background.
I've spent my entire career in financial services. I'm a chartered financial analyst. That's really where my passion is on the asset side of the household balance sheet. I worked in lending for a few years early in my career and been a financial analyst with Bankrate, personal finance website, for over 20 years.
Wow.
And it's obviously seen a lot during that period of time. I think this is an environment that, much like we've seen a few times in the past where, there's some key inflection points. We're seeing households strained right now in a way that inflation hasn't done to household budgets in a long, long time. Interest rates have gone up at the fastest pace in 40 years. I mean, the phrase unique or unprecedented was used a lot during the pandemic, but there are some aspects of that I think people are still feeling it for sure.
No, totally. And it's funny because I went and looked to see last time you were on the show, and it was May of 2021, and a lot has happened since then, right? So you've touched on a few things already, right? Inflation, interest rates. We're in the middle of a banking crisis, right? There's a war going on. So a lot there that impacts the markets and portfolios. So when I think back to May of 2021, right, interest rates were very, very low and a lot has changed. So that might be a good place to start and just give us a general understanding of what's happened since those all-time lows.
Yeah, if we go back just even a little bit prior to that in 2020, of course, at the onset of the pandemic, we had this idea of hitting the pause button on the economy. And so in May of 2021, when you and I last spoke almost 2 years ago, we were coming out of that. The economy was reopening. People were going back out. They were spending money. They had more savings than they had in quite some time because spending had been curtailed. But then there were also debt relief measures, stimulus payments that helped boost bank accounts. Well, where we are today, I think, is quite a bit different. Lower and moderate income households in particular, they've blown through that savings.
Yeah.
Inflation has just stretched and strained household budgets. And so they've had to lean against that savings in an effort just to make ends meet. And so what's changed is that, yes, the unemployment rate bounced back very rapidly. We're some of the lowest unemployment now in 50 years. But we're also dealing with inflation that's been running at 4-decade highs. Households that had boosted savings and paid down credit card debt. When we last spoke a couple of years ago, we've seen that reverse. And again, particularly lower and middle income households, the credit card debt has rebounded, the savings has been depleted. And so even at a time when we have very low unemployment, an economy that's been remarkably solid, there's still a lot of strain at the household level. And that's, I think, been exacerbated by not only inflation, but even what's designed to curtail inflation, the rising interest rates.
Yeah, no, I mean, I think it's really, really hard to navigate this on the everyday front. So what are some of the basic things that people should be doing? Because I think you're right. I think people have been depleting their savings and credit cards are costing them more. What are some good sort of basic pieces of advice that the average person should be thinking about?
Well, let's start with the credit cards because, not only are credit cards costing more, credit card rates are at a record high at a time when credit card balances are at a record high and more people are carrying balances. So that is not a good mix. If you've got good credit, grab one of those 0% or other low rate balance transfer offers that are out there. This does a couple of things. One is that it shields you from further rate hikes that may be coming from the Federal Reserve. But secondly, and more importantly, it gives you this runway. Some of these last as long as 21 months. It gives you this runway to get that debt paid off once and for all without the headwind of interest charges. And that is critically important to getting out of credit card debt. And just on the savings front, nothing helps you sleep better at night and better weather whatever may lie ahead economically, than knowing you got money tucked away for a rainy day. So I can't, I always pound the table about the importance of emergency savings, but it's an easier sell now because you're seeing the best interest rates you've seen in 15 years. So I think, people that are seeing 4.5%, 5% on savings accounts are much more amenable to the idea than the last time we talked a couple of years ago when those just about half a percentage point.
Right. It's that what the investment community talks about is that shift from the TINA market. There is no alternative to equities if you wanted to have yields, to the TARA market, right? There are reasonable alternatives to equities. So what are some of the things that you're seeing people do? Is it just high yield savings accounts, or are there other ideas out there for people who want to increase their savings yield?
Yeah, I mean, well, on the savings accounts, what we are seeing is that because interest rates have gone up at the fastest pace in 40 years, it's gotten the attention of a lot of savers. And so if there's money that's moved from banks that haven't raised their payouts on savings accounts to those higher yielding alternatives. So, if they think of the accordion, when we last talked a couple of years ago, interest rates are at record lows. The differential between the top yielding account and what everybody else was paying was pretty slim. But now that accordion has expanded dramatically. There are plenty of banks that are still paying near zero, but the top yielding banks are paying 4.5%, 5%. That's a big difference. It has captured the attention of a lot of savers who are now taking action and moving their money. If you haven't yet, I encourage you to do so. I mean, it's like seeing a $100 bill on the sidewalk. You bend over and pick it up, and that's really what we're talking about here. I think the other thing that's important is for retirees and for near retirees. If you're looking to set up a predictable stream of interest income, certificates of deposit are back on your radar screen in a way they haven't been in 15 years. It used to be a staple of the retiree portfolio, that laddered portfolio of CDs that would mature at regular intervals. And then interest rates plunged to record lows, and they stayed there for the better part of 15 years. And so I think it kind of fallen off the radar. But now with the surge in interest rates, that's back. The opportunity for retirees or near retirees to lock in predictable interest income for the next several years at 4.5% or 5% is pretty compelling.
Yeah, but it also brings up sort of the idea of what else will happen this year with interest rates, right? I mean, do we think that the Fed will continue to raise rates, or is this something where we're now probably at the top of what they're willing to do?
They're probably not done yet. I mean, it's just because inflation's at 6%. So if we see stability in the financial sector, then the likelihood is that they're going to raise interest rates at least once more. The open-ended question is, how much tightening does the tighter lending standards and the turmoil in banking, how much of the Fed's work does that do for them? Is that the equivalent of 2 rate hikes? Does it end up being the equivalent of more than that? That's an open-ended question. We won't know the answer for some time, but that's one of the things the Fed's going to have to gauge, because again, inflation's at 6%. That's a long way from 2. So more work needs to be done. How much of that is actually going to be done by the Fed? How much of that's going to be done by what's already in place, the tighter credit, and where that's headed? That remains to be seen.
So Greg, explain something to our listeners here, right? Because it sounds sort of odd. The Fed's raising interest rates to bring down inflation, and they're hoping to do that by increasing unemployment, right? It sort of seems like a really odd way of looking at that. Can you give us some understanding of what really they're trying to do there and why that's important?
Yeah, they're not trying to explicitly raise unemployment. That is, an unfortunate consequence of slowing the economy. Interest rates are like an accelerator or a brake on the economy. When the economy is weak, cutting interest rates is like pressing the gas pedal to the floor to give the economy some juice. Well, we're in the other situation now with inflation running hot. They've been raising interest rates, which is pressing the brakes on the economy to reduce demand and get inflation under control. And as it pertains to the job market, we've got very, very low unemployment. But one of the things that is a potential contributor to the inflation we've seen is the imbalance between demand and supply for labor. There's 2 open jobs for every unemployed person. And that is a specific metric that Jerome Powell and other members of the Fed have referenced repeatedly, that tells them how tight the labor market is. That a tight labor market can contribute to inflation. And so that's the number they want to see get lower. They want to see that come back into balance. I think that will tell them at the point where the threat of labor tightness feeding into inflation is no longer present.
Yeah, I think that's really helpful. So it's interesting because if you think about it, right, this is the fastest the Fed has ever raised rates in modern history, right? You see the line and it goes like straight up. And I think it's had some unintended consequences. And so when you talk to investors out there today, the thing that a lot of them are focused on is we have a bit of a bank crisis, right? So give us some context of, why is the Fed raising interest rates? How did that have an impact with Silicon Valley Bank? And what does this mean to investors?
Yeah, the Fed has been raising interest rates to cool the economy, and they've done so at a very rapid pace. But the impact that can have is very pronounced on bonds, and in particular, longer-term bonds.
Mm-hmm.
A lot of investors out there, they probably remember looking at their 401k statement or their retirement account statement back in January and seeing red numbers all down the board. Both their equities and their bonds both lost value last year. The bond market had its worst year since 1975 because of interest rates going up. And so those really low interest rates, the impact on the price is most pronounced on longer term bonds. And so investors that piled into long-term bonds when interest rates were really, really low got absolutely hammered when interest rates went up. And what started all of this turmoil in banking was that one bank in particular piled into very long-term bonds. They did not have any hedges in place. When the hedges that they did have in place expired, they didn't renew. They doubled down on the idea that interest rates were going to fall back down, and interest rates kept rising. And so what that did is that produced the value of their bonds fell dramatically. It's an unrealized loss until you have to sell those bonds. And at the point where they had to start to raise capital, it was a warning sign. So a lot of their customers are starting pulling money out left and right. All of a sudden, they had to sell those bonds they were otherwise not planning to have to sell. And so they started taking even steeper losses. And then it was just kind of a perpetual cycle. They weren't able to raise capital to fill that hole, which then perpetuated the speedy withdrawals. And, it unraveled very, very quickly.
Yeah. I mean, it's unbelievable to think that in 2023, we're having a bank run, right? But I think I think there's this element with investors where they feel like something bad has to happen, right? There's almost been like this sort of, another shoe has to drop. So when you're, and I think one of the things is when the markets are challenging, human nature is such that they want to do something, right? People want to go do something, change their portfolio. When you have a run on a bank or bank crisis like we're dealing with right now, what should investors do? How should they approach this?
Well, the context is important. There's over 4,000 banks in the country. We've had 2 fail, 2 out of over 4,000. So when interest rates go up as rapidly as they have, it's going to expose bad decisions in banking and elsewhere. And that's exactly what's happened in the case of banking. Bad decisions have been exposed. And, that's not to say that there aren't others out there that may have made bad decisions too. They'll be exposed in due time if they have. But again, I think the real risk was when one bank failed, it could have spurred a much broader contagion, which would have been massively problematic for the economy. If every business starts pulling out their uninsured deposits from their bank, that could bring down the banking system really quick. And so that's why there was an urgency for the Fed, the Treasury, and the FDIC to step in, make sure that there was liquidity and that banks were able to meet withdrawal requests. Because the idea is not to prop up bad banks or banks that made bad business decisions. The idea is to prevent a good bank from being taken down unnecessarily by a panic-induced bank run. And so far, knock on wood, I think what they've done has been very, very successful. And the dust appears to be settling, but I still think it's a little early to sound the all clear. Probably going to be a couple of months, as you said, where everybody's trying to assess, is there another shoe that's still to drop here?
Yeah, I mean, I think the thing is when I look at the marketplace, it's not the banks that concern me, is more what's happening in things like commercial real estate, right? because work from home has not been kind to cities. I mean, I'm sitting here in San Francisco and, our occupancy rate is fairly low here, and small banks hold about 2.3 trillion in commercial real estate debt. That's about 80% of commercial mortgages. So how should you, when you're reading about this in the Journal and other places about commercial real estate and mortgages, how should investors be absorbing that data? I mean, is this another potential crisis?
Well, I mean, the commercial real estate's a little bit out of my realm.
Yeah.
But I think it's important to be aware of the risk that's out there. And I mean, I think that's certainly at the top of the list of what people are talking about. I think the other risk is what don't we know about that might still be out there too.
Right.
And that's why I said it's early to sound the all clear, because there's a lot of questions. And as it pertains to the commercial real estate, you're right. Smaller banks, regional banks have a very large market share in commercial real estate. A lot of that debt has to be refinanced here in the next year or two at interest rates that are a lot higher than when that debt was first taken out. So there you have the concern. But again, assessing that and its magnitude and impact on the economy, that one's a little out of my.
Yeah, no, but you do focus on personal, like homes, right? Residential. So what, I think the other thing is here with rates going up, I think it's gotten a lot harder for home buyers to buy. And it's just, you also hear people talk about, well, is that market going to have issues, right? What are you seeing as you look at data from Bankrate on home buyers?
Yeah, I mean, the affordability issue is really front and center, because, the first thing we saw, and we saw this the last time you and I talked 2 years ago, home prices were going up by leaps and bounds throughout the pandemic. And then mortgage rates beginning in early 2022 rocketed higher. And so just as home prices were peaking, you had mortgage rates moving up at a very rapid pace. And so it created a major affordability issue. I mean, the rise we saw in mortgage rates last year alone is equivalent to a 33% price increase. So, as if the run up in prices that have been seen in so many markets wasn't enough, tack another 33% on there and you get a sense of the affordability impact. So needless to say, the housing market cooled dramatically as a result. I think what's remarkable is that, we talk about the housing market as if it's one market.
It isn't. It's many markets.
Says location, 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 right? It's very, very different. And so, I think what you're seeing on the West Coast is a lot different from what a lot of markets in the South and on the East Coast are experiencing right now. And I think that just kind of goes to speak to the importance of those unique local aspects. The fundamentals. Are people moving into the area? Or are people moving out? And those kind of things, and the impact that is having, in addition to those affordability issues we talked about a moment ago.
Yeah. And I think the other thing is it's also an inventory story, right? So you have people who normally would have sold their houses, are concerned that they might not get top dollar. So now they're renting them because it's cheap, because they've locked in money at 2 to 3%. So I think that's also one of the things in certain areas that's becoming challenging, is that there's just a lack of inventory.
Of underbuilding, right? And so that inventory issue compounded for years and years. And it's, I think, perpetuated by exactly what you highlighted. A lot of homeowners are walking around with 2.5%, 3% mortgage rates. They're not in a hurry to sell and go buy another place and have to borrow at 6.5% or 7. And so that inventory issue, which has contributed to the run up in home prices, the inventory issue is not going away overnight. And I think that a lot of the darkest forecasts for real estate, I don't think adequately account for the effect that that inventory issue is going to have in terms of putting a floor under prices in a lot of areas, because it's about demand and supply. Yes, demand has dropped off dramatically, but the supply is still really, really low.
Yeah, no, it's tricky. I mean, I'm seeing different things all over California. I mean, I'm sitting here in San Francisco that has a pretty beat up condo market, but the single family home market is still incredibly strong. So it really just depends what pocket you're sitting in.
Yeah,
So,
I think on the construction side too, you're seeing, there's a lot of apartment building going on, but there's not so much on the single family side. And so, this inventory issue we talk about, okay, maybe you start to see the needle moving on the multifamily side, But, if you're not building fast enough on the single family side, again, that problem persists in the future.
Yeah, it's a bit of a tricky situation right now. So I know you spent a lot of time on portfolio construction. So we're in a very different market today than we were a year and a half ago, right? For people who are nearing retirement, let's talk about bonds, right? And yields, because you talked about laddering CDs. But sometimes people don't want to do CDs because you're locking it in and it's harder to move out of them, right? They don't trade as easily as maybe a bond. How do you think investors after last year should be thinking about bonds and the bond portion of their portfolio?
Well, the valuations are certainly a lot better now. I mean, that's the sort of the upside, if you will, to the sharp price declines we saw in bonds last year as interest rates increased, is that the valuations are now better. So, the ability to get 4.5%, 5% coupons on government debt or very, very high quality corporate debt wasn't the case a couple of years ago. And so for an income dependent investor who's not looking at necessarily selling the bond, they're just looking to garner the income from it, it's a much better environment to do that now. Even though interest rates have gone up dramatically, I still don't think you want to put yourself in the position where you're buying, whether you're investing in a CD or you're buying a bond that is inconsistent with your time. You don't want to be in a position where you have to sell prior to maturity because you're really rolling the dice. If interest rates move against you, you can take a pretty significant loss. So very important to align your time horizon with the maturity of the bonds that you buy. But if you're intending to hold the maturity and just garner the income that comes from it, bonds are a much better deal now than they were before interest rates started to rise, and much better deal than they've been in some time.
Right. You're actually being compensated for being in the bond market without taking on as much risk as you would for a stock. But yet, it's interesting. I think when you look at the 25-year PE ratio, we're at sort of the average, right? So, I think investors are sort of torn of, well, the market feels volatile and I don't feel good about the economy right now. What do I do? Do I just take everything and stick it in cash and bonds and ride this out? Or do equities warrant consideration?
I am not a fan of this jump in, jump out, jump in, jump out.
Me either.
First, timing the market to get that right, you've got to be right not once but twice. You got to know when to get out, and then you got to know when to get back in. Good luck with that. No, I just I think equities are a long-term hold, and they certainly have the most upside now. Market's a little bit pricey right now. I mean, you mentioned the PE ratio close to average, but unfortunately, interest rates are well above the average we've seen over the last couple of decades. And so, from a valuation standpoint, it's still a little pricey. But if your time horizon is long enough, if you've got quality stocks that are dividend payers, for example, IRAs living off that dividend income, you're still seeing dividends go up at a pace that is preserving your buying power even in a time of high inflation. So I'm always a proponent of equity investing, even for those that are in retirement. The money, retirement itself can be 25 or 30 year period. You're going to need to preserve your buying power over that time, and the equity component of the portfolio is the part that's going to do that.
Yeah, no, it's funny. I agree with you completely. Jumping in and out of the market doesn't make the most sense. And it's funny, as you work with retirees, I do find that people in their 60s often say, oh, should I change my asset allocation now? And it's like, well, no, because to your point, you might need it for 30, 40 years. And even if you don't, if you're trying to pass money on to the next generation, you need it to keep up with the cost of inflation.
I can probably see something similar to what I've seen, which is, there's this focus on when you're going to retire, you're going to need all the money that day. And you don't, right? And you're just kind of shifting to, at that point, it's now going to have to last you 25 or 30 years. And so, the asset allocation, it's not this massive shift at points in time as much as it's just a steady glide path. And that glide path begins as you're approaching retirement and continues through retirement. As you age, maybe you need more in income producing investments, and the equity portfolio shrinks over time and you reduce the risk. Some people are in the position that as they age, paradoxically, they can increase their equity allocation because they're thinking of what they're leaving to their heirs.
Yeah, no, and I think also people often, especially here in the US, have a very US centric portfolio. And what's been really, really nice over the past year is if you are in the European markets or you're in the emerging markets asset classes, you're actually getting compensated for being in it. I mean, I'm seeing emerging markets mutual funds throw off yields in the 4 or 5% range, which is unbelievable.
Yeah, for equities, right? I mean, yeah, exactly. So you get the upside of equities with, basically the income character levels that you would see on bonds here in the US. Yeah, and we talked about valuations, and valuations much more compelling overseas. Of course, we've got a decade or so of underperformance of international markets. So, a lot of investors, that may be a tough sell, but from the standpoint of diversification, and the fact that, over time, things tend to go in cycles. And so, we've had extended periods where international markets outperformed US markets. And that's really the essence of diversification. It's, not trying to pin the tail on the donkey and guess what's going to be hottest or what's going to do best, as much as spreading your wealth across various asset classes and within asset classes so that you're well positioned no matter what.
Yeah, no, I mean, it's interesting. If you look at the rally that happened from the end of October to say the end of February this year, international did much better than the US markets, right? And we were happy with the 6% coming off the S&P 500, but you looked at other countries and places like China, it was phenomenal returns for that shorter period of time.
And I think another sort of message for investors, the old adage, it's darkest before dawn. Stocks are a discounting mechanism. They're looking forward, they're not looking backward. And so even when the news is bad, be that geopolitical, be it inflation or interest rates or economic health, whatever the case may be, even when the news is bad, investors are looking forward. And in equities, they're looking at what are the future earnings prospects. If things are really bad now, they might get better in the future. And so, what happens is markets start to rebound even when the headlines are still pretty ugly. And, you don't want to wait. If you wait until the news is good, you will have missed the rebound. You will have missed the rally. So again, equities, it's not about jumping in and jumping out as much as it's just staying on the train. You don't want to be standing on the platform when it pulls away.
Yeah, no, I mean, at that moment where it looks through the economy and starts to rebound, it's just sort of a patience game right now. So
yeah, I think you're being paid for that in a way that you haven't in quite some time. You mentioned the yields, the attractive yields on international equities, and I think even in the U.S., the broad market dividend yield is nothing to write home about. But there are dividend growers, dividend payers that continue to boost dividends, which has been really, really important particularly for retirees at a time when inflation's been so high. That's been what's enabled them to maintain their buying power.
yeah. So, for listeners here, I mean, who go to the Bankrate site, read your articles, what are the 3 things that you would tell people right now that they should just keep in mind as they navigate either their finances or their portfolios?
Well, it's, the debt is very costly, and it hasn't been this costly in a long, long time. If you're carrying debt, particularly variable rate debt, that's something that has to be addressed. We talked at the top about credit card balance transfer offers. Use that as a tailwind to get out of debt. I would stress that. But
Are you seeing a lot of those offers, by the way, just out of curiosity?
Oh, yeah. I mean, almost all the major issuers have at least one card with one of those 0% balance transfer offers. And they tend to last from 12 to as long as 21 months. You get an extended period of time there. So yeah, definitely want to, if you've got credit card debt, that's something that needs to be tackled. Even something that was formerly thought of as low cost debt, a home equity line of credit, it no longer is. The prime rate is at 8% right now. I see a lot of lenders who are charging double digits on their home equity lines of credit. So, if you did a home repair or upgrade a couple of years ago, borrowed money on your home equity line, the cost of that has escalated dramatically just in the last 12 months. And so, that may warrant a little bit of change of tactic there, in the sense that what was formerly low cost debt and didn't warrant the urgency to repay. Now, when we're talking interest rates, 8, 9, 10% on a home equity line, that thinking needs to change.
Yeah, it's expensive. It's expensive money. So okay. So pay down debt. What are the other 2 things?
Well, we talked about higher interest rates, and as savers, you're being compensated for that, and just the importance of having liquidity, emergency savings. But even among investors, having liquidity, you're being paid to wait. So, if you're in the habit of dollar cost averaging, for example, even as that money sits on the sideline and works its way into your portfolio, you're still earning 4.5%, 5% if you've got it in the right place. So I think that's certainly important. And if you are, you're sitting on a little bit of a war chest, you don't want to jump, you don't want to pour that into the market at the wrong time, or you want to be able to pounce if the market rolls over, and you're being compensated in the meantime. That old adage, cash is trash, no longer the case when cash is earning 4.5% or 5%. So I think it gives you a little bit of opportunity to kind of pick your spots, or just dip your toe into the waters if you're not comfortable jumping in with both feet right now.
Excellent. It's great advice. So before we finish up here, tell us a little bit more about Bankrate. I mean, you guys, I see you everywhere, you're advertised, you have great articles, but tell us a little bit more about the organization.
Yeah, thank you. Bankrate.com is a personal finance website. And there are really three pillars of areas that I would point to that benefit the audience. One is that you mentioned the content, publishing articles to the site every single day to inform people about what they need to know in the world of personal finance. How does what's happening in the world outside impact your pocketbook? We also have free search engines where you can find those 0% balance transfer offer credit cards. You can find those 4.5% and 5% online savings accounts, where you can find the best rate going when you're getting a mortgage. Certainly utilize that. We do the comparison shopping for you and put it in one place. And then third are just calculators. We have a lot of free calculators that you can use to do your due diligence on how much can you afford, or how long is it going to take to get out of debt or accumulate the nest egg that you need to send a grandchild to college, for example. So, all of those that I mentioned, the content, the search engines, and the calculators, all of that is free to the consumer.
Yeah, no, I love your calculators. I use them. So, well, anyway, so Greg, where can people find you? I know you're on the site and you have your articles listed there. Was that the best place for people to find you?
Yeah, absolutely. Yeah, on the site, myself and my colleagues, you can follow me on Twitter. I'm at Bankrate Greg, and Bankrate. You can certainly follow Bankrate on social media as well. They're on all the platforms.
Excellent. Well, Greg, thanks for being on. It was great touching base on the market, and hopefully things will improve from here.
Fingers crossed.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
And now on to the panel portion of our show. And this is a treat for me today. It's just me and Kirk Chisholm. Kirk, welcome to the panel portion.
Thanks for inviting me on the show here, Megan.
Yeah. Or thanks for having me sub for you to this week. So anyway, this was a really interesting interview with Greg. And I think, you know, as you and I both work with clients, I think you probably felt it's a lot of the topics you're talking to your clients about.
Yeah, I mean, these, you know, this is such an important time right now in the markets. I think, you know, I don't think people really understand how important of a time this is. And, you know, the normal markets, when there's a bull market, it's easy, right? You just point and shoot, right? Point and allocate, and you're going to do okay. But in times like this, you know, we are truly in a paradigm change that people aren't going to understand for many, many years. And they're going to look back and say, oh, that was the date. Yeah, it was a few years ago. It changed. And now people are starting to see the impacts. So I think what's really important is that people understand this paradigm and, you know, rethink their whole portfolio construct. I'm not saying it's right or wrong. You know, I don't know what you're all doing. You know, hopefully you're doing the right thing. But the idea is to relook at your portfolio and say, the paradigm has changed. What am I missing? What am I not focused on at the moment? And what do I need to reassess, right? Like, we all have these assumptions we bake into our portfolios and our quote unquote understanding of the financial markets. And the questions we should be asking ourselves are, do the assumptions that we formerly held, do they still hold true, right? Maybe they do, maybe they don't. I would argue that some don't and some still do. And I think if you're not having that kind of a conversation with yourself and doing some analysis on it, then you're really doing yourself a disservice. So I know we'll talk about that a little bit, but I just wanted to kind of set that framework up because I think it's really important that people don't just get lazy. Like, sit down and say, all right, here's what I'm doing. I'm doing buy and hold, I'm doing diversification, and just lay out all the constructs that you're using for portfolio construct and say, do these still hold true? And assess them and say, what am I missing? What do I need to think about? And certainly ask, you know, send us questions. We'll happily answer them on the show, but these are really important things you should look at.
Yeah. So that leads me to a question from a more practical nature, right? So much of the work that we all do with clients is sort of modeling out what will happen to see if they can purchase something or retire. So, you know, Greg brought it up on the interview, you know, inflation now is at about 6%, you know, off an all-time high of about 9% last June. Obviously, we're talking about core inflation. So when you're modeling for clients, like, you have clients coming to you and saying, hey, Kirk, I want to retire. How are you factoring inflation and what's going to happen with inflation into your models? Like, what is the conversation you're having there?
It's a great question, Megan. And I have to say, it's probably one of the hardest questions that our industry is facing right now, is that we've spent pretty much the last 20 years of inflation, which was low, in some cases almost non-existent, even though technically existed, you could argue. And I would like to define the inflation here, because I think there's multiple ways to look at it, and this is really important too. So if you look at inflation, most people define inflation by the CPI, right? And the Consumer Price Index. And there are multiple versions of this, so I'm not going to get into the weeds here, but the CPI is typically what people look at. It is typically what is gauged for other metrics, like government metrics. Like, they look at the CPI as kind of the general standard. Now, I don't know whether that's a good standard or not. That's a different question, and that's a different question for a different episode. But it is important to recognize that it may not be accurate. And the reason I say this is because if you've been to the store lately, you know it's not accurate for you. But, you know, if you're saying it's 6%, you'd say, well, I know, but, you know, the last quarter, my food prices went up 20%. It's not reflective of that. It's 20, not 6. And you might say, well, college went up 7.5%. Well, that's not reflective. Well, my home prices went up 20%, you know, 2 years ago. So I think in looking at the CPI, is it reflective of your household expenses? I don't know. Everybody's household's different. If you,
Kirk, can I just ask you a quick question? Did you see that calculator that lets you calculate your personal inflation rate?
no,
Because I think you're bringing up a very, very powerful point. My inflation rate might be 6 and yours might be 10 because you bought a used car, right?
right.
I think this is really, really important what you're saying here.
Yeah, and we'll put the link in the show notes for what Megan's referencing, but the point really is that, you know, the CPI may be reflective of the country as an aggregate. So if you take everybody's personal CPI and put them all together, they might be 6%. And I think, like I said, people argue whether it's 6. I'm not going to make that argument here. Let's assume it's 6 for this example. But what basically happens is they aggregate everybody's personal CPI and it comes out to basically 6. Now, there's another side of this, right? The CPI is supposed to measure our personal expenses, right? Our what we pay for housing, which is now I think 45% of the CPI is what we pay for housing. Then there's food, then there's transportation, there's energy, there's all these different factors that come in, and you put them all together and it equals 6. Now, the personal inflation rate for a lot of people is going to be probably higher. The expenses for food, you know, if you're spending most of your income on food, it's going to be a lot higher for you. If the expenses on transportation are high, it might be a lot higher for you. Maybe not this year, but 2 years ago to last year was a big jump. So you have to take into account that these things are going to impact you. Right now, my heating costs went way up over last year. I mean, it's probably 30, 40% higher this year compared to last year. So each of these factors is going to play in. Now, the important thing I want to bring up here is this is on the expense side. Inflation is really high. The goods and services that we're paying for are really high. Those are skyrocketing. However, if you look at asset values have come down quite a bit, right? Or they're coming down. Right? I don't want to jump the gun here. Real estate is starting to come down in certain parts of the country more than others, but asset prices like real estate or portfolios, stock and bond portfolios have come down. So even though we have inflation in some areas, we're getting deflationary effects in other areas. Now, which one is correct? I don't know, right? We're laying out the framework for how you need to understand the world works. Most people look at the CPI and they say, all right, that's the inflation rate. Or they say that, well, my food is 20%, so everything else is 20%. It is a complex calculus of looking at your household, you know, income and expenses and assets. How are they moving, right? So the answer to your simple question, Megan, is actually quite complex when you look at the answer. If you're looking at the expenses are actually going to be probably higher than the 6%. So you have to model that and say, well, is it going to be 20% a year indefinitely? Well, probably not, right? It's just because it's 20% doesn't mean every year is going to be 20%. And I think we have to take this into consideration. If we're looking at this over like a 5-year period, it's probably not going to be reflective of the last year and a half. Like, I'm just being frank, even though I think we're going to have high inflation, I don't necessarily think it's going to be continuously 6 to 10%. I think, you know, it's possible, but I think it's more likely to go up to maybe 10, then down to like 4, and then back up. I think it'll be a volatile range. So how do you model that? Well, there's 2 things you have to model. One is the expenses. How much you're going to be spending in retirement is going to be somewhat reflective of where we think it's going to go in the next 5 to 10 years. But then there's the other side of it, which is your asset prices and your real estate, right? Is how do you balance inflation reflecting into your asset prices? Because we have high inflation on this side, right? On the expense side, and income is probably, it's a little flat. It's gone up a little bit, but it's not keeping pace with expenses. So it's really not balanced there. So you have to take into account for that. But then you have the asset side. So not only are expenses going up, but the asset prices are coming down, which means that if you saved $1 million in retirement in December 31st of 2021, well, now you might have 700,000, right? Well, how does that play in? So not only do you have to balance the fact that inflation might be higher going forwards, but now your assets are lower, which means that you're actually getting yourself into a pickle. because you have fewer assets that have to produce not the same income, but a higher income than you had before. So I think you're getting squeezed both ways. And most people look at one side of the equation. You really need to look at both.
So this is interesting because, when you think about this, right, and I'm seeing this in client portfolios where the income coming off the portfolios now are higher than the income coming off a year, 18 months ago, but on lower balances. So when you're thinking I know everybody in the industry is excited. Cash is an asset class again, right? Bonds are becoming more appealing again after such a rough year last year. So how should investors use yield to their advantage to weather through this? Because to some degree, to fight inflation, you have to stay in equities and you have to stay fully invested.
Yeah, and I would just like to point out, Megan, you already know this because you've been with us for a while. We've been talking about cash as an asset class for the last few years. For like the last 4 years, we've been talking about
there hasn't been yield.
There hasn't been yield, but we've been talking about cash as an asset class because cash has two purposes. And when I say cash, I really want to define this. When I mean cash, I mean actual cash, but I also mean short-term cash equivalents, as we call them, short-term treasuries or short-term CDs or short-term bonds, things that are really short-term that are producing a better yield, right? But the point of quote unquote cash or cash equivalents is that it's safe, right? So 4 years ago, when we were talking about cash, we were talking about it because you could, you look at fixed income and it goes from like a 0 maturity date, which is cash, all the way up to like a 30-year maturity date. And you could buy fixed income anywhere along that curve, right? From today, which is cash, up to 30 years. You could decide which one you want to buy. And 30 years is typically the best rate because you're getting paid for the time you're putting in. And one of the reasons that SVB went down was because they were buying the best yield they could find, which was 20, 30 years in the future, which was a really bad idea in hindsight. But the reason 4 years ago
it wasn't the reason it was a bad idea is they also didn't factor into their models that their deposits could come down. That's where they got burned.
True.
Right.
And of course, it came out yesterday that SVB executives found out their models were broken, so they changed the models. That to me was hilarious. But
that's never good.
Yeah, that's never good. You don't. And actually, this is a really good point. So I want to take a step back and hit this point. One of the problems with models is that a lot of people, and this is Wall Street, this is science, because there's a lot of things like global warming, which science is all based on models. Like it's not based on necessarily data because you can't really look at the equation. It's too big and too complex. We can't actually calculate it. So you look at models. Use models to calculate what they think the effects are going to be. And it's not just global warming. A lot of science is done this way. This is based on models. So the problem with models is if the model is correct, then it's a really good model. But if the model is wrong, then it's going to produce a bad outcome, right? And so your conclusion is going to be inaccurate because it's based on an inaccurate model. Wall Street,
garbage in, garbage out, right?
Exactly. So a lot of Wall Street is based on models, and they're really generally pretty accurate models. The problem is that when you're basing and this is a human problem, by the way, not necessarily a model problem, is that if you create a model, you look at it and you apply it to the situation, you say, is it reflective of this situation in many situations like it? If it does accurately reflect those situations, and actually economics is based on models, so just to make it clear, is that if it accurately reflects it, then it's a good model. Now, what tends to happen on Wall Street is they look at data and they put that data and say, all right, this data reflects this model, and they create a model around the data. Well, the problem is the model may not necessarily reflect the data. So if I'm creating a fund, right? I look at, it's called back testing. So you back test data. You look at all this data and you just say, well, if I had done this thing, I would have made lots of money. 90% of the trades would have been accurate. We would have been rolling in money. We'd be a trillionaire right now. If I look back and applied this model to history, I would have been a trillionaire. Well, what's the problem with that? Well, the problem is I retrofitted the model around history. and history doesn't repeat. So it doesn't mean that it's going to work in the future. And frequently it won't, because things change. And a good thing we just talked about earlier is the paradigm change. If you looked at the last 40 years and that's your model, you might have been a huge success. But that model today is not necessarily going to be reflective of the last 40 years because the paradigm has changed. We have higher inflation. We have increasing inflation, increasing bond yields. We have, we had growth doing really well and value not, and now value might do better. There's a whole bunch of things that are changing.
Mhm.
But if you applied the old model, you'd be grossly incorrect and you'd probably lose a lot of money, right? And this is the problem with models. So the problem isn't that the model is necessarily broken. It's that people don't look at reality. They look at data and they divorce the data from reality. And they're not looking at reality. They're just looking at the data and saying, oh, well, the data says this, so I need to do this. And they're not taking a step back and say, well, actually, all these assumptions have changed and we haven't changed the assumptions in our model to reflect that. So this is why it's really important to understand the new paradigm, is that all of your modeling, and for most of you listeners, you're not financial experts. Some of you are, some of you are not. Most people are not. You're not modeling this. But if you're doing a model on any kind of model, if you're just looking at history and saying, this is what it's done, I'm going to repeat this in the future, you're going to make a lot of mistakes, because history does not necessarily repeat itself over and over and over again. It goes through cycles. And right now, the paradigm change we're talking about is a new cycle. And the cycle has a lot of different assumptions that are changing. And those new assumptions have to be calculated into the new models. So SVB, they changed their model because they had made a calculus and said, here's the decision we're making. Now, obviously, we made a mistake, so we're going to change the model to reflect this, what we already did. And it didn't do them any service. It caused them to go bankrupt. As Megan, as you said, obviously they didn't account for people pulling out money, but they're a bank. I guess, anytime people pull out huge amounts of money, they're going to go insolvent. It really was not reflective of their, if you want to have an honest conversation about SVB, the fact that they had miscalculated their bond portfolio, it didn't matter if you were really conservative. If you were invested in anything and you had 20% of the people pull out their money, you're still going to be insolvent. So I think that's the honest conversation that people aren't having, is that if people pulled their money out of any bank, 20% of the cash went out, you would have the same problem. SVB's was exacerbated because they had not managed their risk properly. So I think they could have gotten out of that earlier, and they decided we're going to stick with it, and they were incorrect. So I think that was the end point. But getting back to your point, Megan, of what you're saying with the calculating the inflation with portfolios, the important point is to think about how am I going to model this? How can we model this portfolio around this new paradigm, which we don't have a lot of data for because it's brand new. So we don't know how it's going to react. Well, I would suggest that there are a few historical points which you can apply this new model to. And this is why I talk a lot about the 70s. The 70s was a period which is going to be similar, not mirror. It's not going to be exact, but it's going to be similar enough where you can look back and say, okay, here's a set of data points that we can model and say, what is this going to be going forward? Well, what happened in the 70s? We had stagnation. We had economic stagnation, which means there wasn't much growth, wage growth, economic growth. We had high inflation, right? And asset prices pretty much stagnated for that period. So we had a period where your real estate, your stock portfolio didn't go anywhere, right? Let's call it zero. It did actually go up and down a lot, but let's just say it did zero for 10 years. Okay. It didn't grow. You had high inflation, some cases 20% inflation, right? It wasn't all 20%, but let's say it was 10%. I'm not going to go through the numbers. Let's say it was 10%, right? So you have no growth in your portfolio, no growth in your wages. You had 10% inflation. Well, you can model that, right? With your retirement, you put in 10%. And I think that would be a good number to use for that period in time. Now, are we going to get 10% for the next 10 years? I don't know. But I wouldn't say it's going to be zero. But so the complexity of what Megan asked with the equation is you're trying to balance asset prices, you're trying to balance income, and you're trying to balance expenses. Now, I think we can safely assume that asset prices are not going to appreciate much in the next 5 to 10 years. It's certainly possible, but I think given the numbers that I see, it's highly unlikely that over that period of time they're going to appreciate much. I think it'd be like the 70s where it's pretty much stagnant and flat at best. Now, I think we're at a high point, so I think we could probably go lower, but let's just say it's going to stagnate for 10 years, okay? Now, we have high inflation. Wages are probably not going to appreciate all that much if we go into recession, which is the Federal Reserve's intent. They've said that very clearly. We want to send people into recession. So using those assumptions, we have to assume a inflation rate, which is rather high historically. So we could assume, let's say 5%. I'm just throwing out numbers. I'm not saying it's accurate, but I think right now 5 to 6% is probably a range where it's safe for us to look at for inflation, given the data we have right now. So what I would do in this case, because I don't know what the stocks are going to do, right? People have stocks and bonds. I don't know what they're going to do because we can't tell the future. I don't know what real estate's going to do because I can't tell the future. I have my assumptions, which we talked about, but let's say they're zero. So let's just assume for the moment that those things are not going to appreciate and wages are not going to appreciate. And I'm assuming that there's a 5% inflation. The simplest way to do the calculus, and I'm pretty much just blowing my industry out of the water here because I'm making it really simple for people and saying you don't need us, but you're listeners to the show, so we want to help you out. The simple way to look at it is assume your portfolio is not going to grow and just plug in 5% inflation. And that is going to give you probably a relatively accurate number of what you can expect over the next 5 to 10 years. Assuming my 5% is accurate, and I'm not saying it is. I'm just saying for this example, you keep everything else the same and you look at 5% inflation. And making that assumption, that will give you a close proximity. Because if you look at all these other factors, right? You look at portfolio growth, you look at income growth, you look at expense, you take all those and you're throwing stuff around, you're saying this is all complicated. Why not make it simple? Keep them the same and move one of them. And you can actually get pretty close. It won't be exact, but you can get close enough where you can approximate it. You need somebody like us to get more specific because this is not this simple, but I'm giving you like a rough guideline of how to think about it. When you get into the weeds, it's really important because housing may go up 30% and food may go up 30% and healthcare may only go up 5%. Well, if you're 50, you don't need healthcare. If you're 70, you really do. So I'm trying to make it simple, but it really is more complicated than this. So if you look at that, that's a simple way to do this and to look at inflation. That's how I try to look at it, to simplify it for people. And then we get into the weeds and we drill down for all these different components to see which one is more important at which stage in your life.
Yeah. You know, it's funny. We do things a little different in terms of models because when we've always run models, you know, we have always run them with different types of inflation assumptions and return assumptions. Because what I want to do is give the clients an understanding that, you know, from 2000 to 2021 to, 2021, inflation was relatively low, it was 2% and below. And so we've always run, our long-term cash flows with that inflation number and then have grown it out so that they can see that if we went into a high inflationary market like we do today, a lot of what they were getting in return was just going to be made up by inflation. And so I think this goes to, what are the things you can control and what are the things you can't control? You can't control the markets. You can't control inflation, right? I mean, you can control your personal inflation rate by making certain choices, but in general, you can't control inflation. But what I often point out to clients is the thing that you can control is spending choices. And so, taking what Kirk said and what I've said, the other sort of leg to this stool is what can I do to mitigate low returns or high inflation on my overall asset base? And it's really, really important to go through all of your expenses with a fine-tooth comb and really start to figure out which levers you can pull on, if there are levers you can pull on. I've done this with clients and we've gone through all the expenses, and there really isn't anything we can choose to mitigate. But I do find going through the expenses, even if there's nothing we can get rid of, helps calm people in navigating this type of marketplace. So really, as you go through this, remember the things like inflation, investment return, that is not controllable. Spending is controllable. The other thing that's controllable is making the choice to have a strategy and stick with it. So Kirk, towards the end of the interview, Greg and I talked a little bit about jumping in and out of the market, right? And he used an adage that we hear a lot of people in the investment world say, which is, if you decide to jump out, you have to decide to jump back in. So it's really two decisions. And when they study those two decisions, most people get one of those wrong. So it'd be really, interesting to hear, what is your take when you have clients or investors today who have watched their portfolios come down since November of 2022 and really just feel this malaise? What are you saying to them about, if they say, maybe I should just go to all cash right now?
Yeah, it's a good question. I actually want to, before I hit on that, I want to touch on something you just talked about, which you mentioned you're looking at different scenarios. I want to highlight this because what you just said is so important that we talk about it on the show a lot. And I don't think we give enough gravitas, which is why I want to highlight it right now, is most people look at their investments and their financial planning with outcome-based thinking, which is they look at one scenario and only one scenario, and they say, this is what it's going to be. And most financial advisors do the same. And I know Megan doesn't, but a lot of financial advisors do the same. Here's your number, right? What was that commercial? Who was that company that was like, you're walking around, people have a number over their head. It was like, this is my number. And you remember that? It was,
sorry, I was on mute. Yes, this is my number.
Yeah, I forget who the firm was, but it was a brilliant commercial. But at the same point, it's completely wrong because you don't have a number, right? You have a range, right? Because if you have a number, you're assuming you're going to hit it, and you're not going to hit it, right? You could be high, you could be low, but you're not going to hit it. And so the idea is you don't want to have outcome-based thinking, which is making the assumption that I'm going to have this number, I'm going to retire in this date, my expenses are going to be X, my income's going to be Y, and you have it all laid out. That's not how it works, right? That's outcome-based thinking. It's like saying, I know who's going to win the next election. I know what the weather's going to be like tomorrow. I know what the stock market's going to do. We don't. As Megan said, we can't tell the future. So I'm highlighting this point because you need to change your thinking. We talked about changing assumptions. This is one of them. Don't look at the world with outcome-based thinking. Look at what we call scenario-based thinking. Scenario-based thinking is looking at the portfolio and saying, as Megan said, what do we do if this happens? What do we do if this happens? What do we do if this happens? So you change all the parameters around, you see, all right, things are going to fall within this range. All right, we want to take conservative assumptions. We want to make sure that we're not assuming 10% a year, which is crazy. Let's assume 2% a year. What happens if that happens? What if it's 4? What if inflation is 2 or 6? So you move all these levers, like Megan and I are back here moving all these levers around, saying, all right, we're going to move all these levers and we're going to see what happens. What's the outcome? But we try to aggregate all that together and say, all right, here are the most probable outcomes, and here are the ones we want to shoot for, right? We may miss high or low because we don't know what's going to happen in the future, but we try to narrow the range of outcomes so that you're saying, all right, if it falls within this range, I'm going to be okay. Because ultimately, at the end of the day, isn't that all you care about, is that you're going to be okay?
Yeah. And I think it's that I've often seen this visual, it's a pyramid, right? And you can break the pyramid up into 3 buckets, and each bucket or each layer of the pyramid is supposed to serve a different purpose in your goals, right? So if you're able to break it up amongst those types of different scenarios, it helps alleviate some of the anxiety we can get in a marketplace like this.
Yeah.
So then
question.
Kirk, going back to my question, right? You have a client or investor come to you and they say, Kirk, I've been watching my portfolio go down since November 21. I don't see any hope here. Everything's just dismal. Pick your flavor, right? War, inflation, politics, right? All of that fun stuff. They want to go to cash. Is that the right decision?
So it's a great question, and I think it's worthy of conversation. I think one of the things that I mentioned earlier is challenging your assumptions. One of those assumptions is buy and hold. Is buy and hold the best strategy? Right? I'm not going to say it is or it isn't. I have my opinions, but I think the important thing is to challenge that assumption. We assume it's correct because it's been correct for 40 years. So of course it's correct. It's always correct because people, the people who've been investing longer than 40 years aren't really around anymore, or some of them are, but not as many. So you don't have that institutional wisdom. You don't have people like Warren Buffett who are saying, oh yeah, buy and hold because it's great. Of course he's incentivized to say that, right? As one of the most reputable investors of our time, he can't come out and say sell. He just can't. I mean, let's be honest. Even if he thought that was the best thing, he's not going to do it because that would be catastrophic and the markets would crash. So, people like him and Ray Dalio, they have another level of responsibility that Megan and I don't have, right? They can't come out. Ray Dalio says cash is king, or cash is trash, is what he said. And he said this in early 2022. He said cash is trash. And I just said, no, it's not. Cash is king. Like, why wouldn't you be in cash right now? That's crazy talk. But he has a responsibility. So I kind of preclude people like that from the conversation because they have to be one-sided, right? There are other financial firms who will come out and say cash is trash because if they don't, then people will sell all the stuff and move their money out, and these people will lose lots of money. If you think of the big investment firms like JP Morgan and Morgan Stanley and Fidelity and TD and Schwab, like all these big firms, their incentive is to keep you invested. Wall Street's incentive since the beginning of time and since it started was keep investors invested. It's always buy, it's never sell. So keep that in mind, that this is a construct that is always going to be there. If I had the golden ticket and it said on this day the market's going to crash 99%, and I told everybody Wall Street's going to be like, nah, we've seen the data, it's not true. Even if they knew it was true, they would say it's not, because the reality is they want you to buy. They don't want you to be sitting in cash. So I say this because it's an important part of the conversation. Okay. Now, buy and hold has a place in time. For the last 40 years, buy and hold has been a great strategy. It has worked. It has worked really well, especially for bonds. Yes, there are good and bad periods during that period, but buy and hold overall worked well. Now, from 2000 to 2013, it didn't work very well. That was a period similar to the 70s where it went up and down, but basically didn't go anywhere for a long period of time. So that was a period where you basically didn't make any money for 13 years. So you lost time, which is the most valuable resource we have. It's not money, it's time. Time is what allows compounding to work. Time is what allows you to do whatever you want, right? If you could stick money under your mattress for 13 years versus stick it in the market and have it go up and down, or basically down for 13 years and then come back, well, what's the point in taking risk, right? So the point is that time is valuable. So the question is that time best used in the market? Or is it best used somewhere else? And this is the question that people should be asking right now. Is my time best used in investing in stocks or bonds, right? Or is my time best used investing in a CD or treasury or a bond that's yielding right now close to 5%? As of today, it's 4.7, something like that, 4.6. But close to 5%. Is that a better use of my time? Now, let's call it 5, just to make the numbers easy. If it's 5, I think it's around 13 years, it would double. So if you had 5% for 13 years, it would approximately double your money. Well, wasn't 13 years around the period that 2013, where the market went nowhere? So you could have doubled your money over that period, putting it in a 5% bond, which you could have gotten back then. I think you could have gotten 6%, 6 to 7 in bonds back in the 99 and early 2000s. I think it was right in that range. So for 10 years, you could have gotten that. You could have gotten close to double your performance versus the S&P, which would have gone nowhere. So I only point this out because everybody is focused on equities. Equities. That's the only way you make money. It's not. It's not the only way you make money. Bonds make money. like there are other assets out there that people haven't considered for 40 years and they should reconsider. So if you have to look at what are my choices? Cash, bonds, stocks, real estate, commodities, whatever else you want to throw in that bucket, right? So you look at all your different choices, say which one has the highest probability of success. Now, I talk to aggressive investors. They're like, 10 out of 10 on the aggressive scale. And they're like, why are we not in equities? I'm like, I don't know. Do you want to make money or do you want to be in equities? Which is your favorite choice, right? It's like, you want to be in equities, we'll put you in equities. If you want to make money, you shouldn't be in equities. Like, and so you need to reframe your thinking around all of these assumptions. Is that why are you thinking this? Well, you're thinking it because you're conditioned to, because it's been true for the last 40 years. It doesn't mean it's going to be true for the next 40 years, but it has been. So in order to rethink this, and honestly, in the early 80s, bonds were awesome. You didn't want to be in stocks. I mean, you could actually make good money in stocks, but you actually made, and this is actually a trivia fact, the best performing asset for that 40-year period was not stocks. It was 30-year zero coupon treasuries. That was the best performing asset class for that 40-year period. It was not stocks. People think it's stocks. It's not. So just understand that that if you look at the equation without thinking it through, you're going to miss some obvious points. And fixed income is one of them. Now, you talked about jumping in and out, which is getting back to your question. So jumping in and out, we're in a market. So if you looked at the 2013 period, if you were jumping, quote unquote, in and out, and I don't mean every day, I mean, strategically, you actually could have made really good money during that period. But if you were buying and holding, you lost money for basically 13 years until you started to make a positive return. So jumping in and out is a question of timing. Are you doing it 5 times a day? Are you doing it 5 times in a week, 5 times in a month, or 5 times in a year, or longer? Like timing the market. People talk about, I can tell the future, or I'm going to predict where the stock's going to go. There are day traders that make a lot of money consistently year in, year out, much more than you'd advertise. And I don't want to promote it on the show because it's really hard to do. But I know people are making 20, 30% a year on the show on their day trading because they have a strategy. They stick to it. They're consistent. There are a lot of successful traders out there, and there are even more failures. So I'm not promoting trading. I just want to be clear. I'm promoting another style of looking at the equation, which is jumping in and out is hard, right? As Megan said in the interview, like you got to pick when to jump out and when to jump back in. Those are hard decisions. You're making more decisions and when to get in and out, and you'll probably be wrong more times than you'll be right. Statistically, most likely you'll be wrong. But the people who are good at it do really well, and it's actually a lower risk way to invest if you do it right. And it depends on your trading strategy. And I'm trying to disclaim everything because there's so many rabbit holes you can go down. You could be a day trader, you could be a swing trader, you could be an arbitrage play. You could do so many different things, and each one has its own risk to reward. But a good trader will look at trades that are you make $3 for every $1 you could lose. So you invest $100, you could lose $100, or you could make $300. That is a good trader outcome, right? And assuming it's 50-50, right? I'm making a lot of assumptions, assuming the odds are 50-50. So that would be a winning strategy, right? So you can successfully trade in and out, or you could do it strategically. Some people do they do trend following. If the market is above the 200-day moving average, they buy and they hold. If it's below, they sell and they go into cash. There are many different strategies people use that are not necessarily buy and hold. But the market we're in is not a market that most people have seen in 40 years, and people are not going to know how to manage it. So if you're buying and holding, or buy and forget, as I call it, you're going to be in for a rude awakening, especially if you're in the wrong places. So
yeah, look, it's funny. We clearly in my firm, we're much more about a long-term diversified approach. So we do buy and hold, but to your point, you have to have the right underlying asset selection to hold long-term in, and so I do think if you are a buy and hold person, it's also about doing continued due diligence. So, and this is common at a lot of firms, but, we are constantly meeting with our managers, constantly trying to understand what's going on there to make sure that we're thinking through all the potential risks. And I do have clients that want to take advantage of some of the market momentum. And we've always been much more of, okay, you've got your core portfolio, it's buy and hold, long-term strategic asset allocation, but it's okay to also have a play account to do some of the stuff that you want to do as you watch the markets move around. But again, I always say that the best investing is incredibly boring. And so, the buy and hold, over the long term has worked. And so, again, it's about figuring out who you are as an investor. So Kirk, as we sort of wind down here, for investors, as I asked Greg at the end of the interview, what's your best, tip right now for investors as they navigate this market?
So I'd say my best tip right now, Megan, would be patience. It's an underrated tip, but I think right now the best tip that people could have is exercising patience. And I say this because I've been having a lot of conversations with clients over the last 3 months, and they're good conversations, but I think I'm understanding the sentiment of what people are feeling, and people are feeling anxious. They're feeling like they need to get back into the market. They need to be in equities. They don't want to miss out on the upside. All of these things that are FOMO mentality. And it's totally normal, right? This is a human thing. It is totally normal to feel this. You're either on one side of the spectrum or the other. Fear of missing out, FOMO, or fear of loss, right? It's either one or the other, right? Those are two very strong emotions. When the market's going up, fear of not making as much as my friends, or I'm missing out on opportunity. If the market's crashing, your fear of losing money. You can't have it both ways, right? You have to find a balance in the middle, right? And you can have it both ways, but it has to be a balance. You can't be on the extreme. Because if you're in the extreme, you're always invested or you're never invested, right? So you have to find a balance somewhere in there to have your cake and eat it too, which is make money when the market goes up and not lose when it goes down. That's the ideal. It's somewhere in the middle, and you have to find your way to do it. We have our method, Megan has hers. Everyone's got their method, but you have to find one. But the problem is patience is in short supply. So if people spent the last year in fixed income or whatever, right? Let's say you're in fixed income. Let's say you rode out the sell-off. You're like, all right, it's bottomed. It's a great time to get in. Has it bottomed? I don't know. Like, why are you saying it's bottomed? Can you tell the future? Like, this is the problem, as Megan illustrated earlier, is you don't know when to get in and when to get out, right? You don't know it. In 2021, it seemed kind of obvious. Things were really expensive. I would say things are still really expensive, but they're a lot messier to make a decision here than there was there, right? 2009 in March, it was pretty easy to determine I can take a shot at here. You may not go all into the markets because the world was kind of coming to an end at that point, but you could make a calculated decision, say, I'm going to put 30% of my portfolio in. This is a good price. Maybe it goes down another 50. I can put another 30. At some point, you're going to have to make a decision to buy. However, the challenge is what is your best probability? Like, what's your best probability set, right? Like, is there a high probability here of the market going up or going down? And what is your potential outcome if it goes up or down? Now, I had talked to a guy in the show a while ago. He suggested here there's about a 20% upside potential from here, and there's about a 45-50% downside potential from here. That, to me, if it's 50-50, is not something I want to be playing around with. Like, I don't like those odds. If I was in a casino, I would not play that game. So the way I would think about it is, if you're patient, if you can sit around and take 5% and not worry about making 10% in a month, like some people did at some points in time, and like, oh my God, I'm missing out. Just 5% is okay for a year. It's okay, right? It's not, you're not losing money, you're not killing it. But if you can be patient in times like this, and I think it's more of training your mindset to be patient. If you can do that, then you will make better decisions, and you're not going to be forcing yourself to feel like you need to be in equities all of the time. And equities are great. There's some equities that are doing really well right now. But as a broad statement, you need to recondition yourself to be patient and not to feel like you need to be quote unquote in the market, because I don't feel like that is going to be the standard fare for the next 10 years. People will talk about it probably for the next 2 years, and they're still going to be thinking that, but at some point they're going to realize, oh crap, we made it a wrong choice. We need to get back into fixed income. So I think patience is a virtue right now, and that would be my biggest tip for the week.
Okay, well, that's really helpful. So I'm going to sign off and say I'm Megan Gorman. You can find me at Forbes.com/Megan Gorman. Kirk, take it away with our disclaimer.
All right. Well, Megan, thanks for coming on the show. Always love your interviews. It's nice to take a break every once in a while and get a smarter mind in there to do it than me. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.